Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 21st, 2019. In this video, I want to cover precious metals. We'll do an all-inclusive video, so I'll hit on all of the metals, or at least the four big ones: gold, silver, palladium, platinum. Roll into the US dollar because that has a big impact on where gold heads. And also we'll wrap it up with the mining ETFs such as GDX, SIL, maybe SILJ. Alright, so we'll start out here with GLD. This is the ETF for gold. Very liquid, popularly traded. Tracks gold very well, so you could get by just using this chart, but we'll roll into the futures here in a minute. Okay, what stands out to me most important right now on this daily time frame is this the clear negative divergence. I mentioned this in recent videos. Right here we had divergence building up to this point. I actually showed you that being the divergent high. We actually put in about an equal high there, and so you have negative divergence either when you have prices rising with the indicators falling, and or you can have equal highs and then lower highs in the indicators. So really we had divergent high 1. This is where the divergence was finalized, and then you can see a big drop. So you have to take these serious. They're not sell signals in themselves, as I often say, merely an indication that a trend change is likely. So we were in an uptrend to that point, big correction. At that point we then rallied. You can see positive divergence down here on the RSI at that low. We rallied all the way up here, came full circle with again divergent high. There's your negative divergence. So and that was about, I think, going from memory, maybe a 9%. I covered it the other day, whatever it was. Let's see here. It was a 6% drop in gold. Miners dropped twice that much, over twice. And then we had, I don't know why it's not here. I thought I had it before. Looks like we had a small divergent low at that point right there, small divergence on the indicators, and that led to this. So here it is, divergent high. And as I said this morning and I've mentioned recently, most likely, not guaranteed, but most likely, whether these divergences play out for a meaningful correction or not will most likely depend on what the stock market does. If the stock market were to turn down soon, we're still struggling, with those resistance levels on the daily chart. And if the stock market were to turn down and take another impulsive leg down, it's unlikely you'd see gold drop to any of these targets because it would continue to get that flight to safety bid. It is possible. There are times, that the relationship disconnects. And so, again, I wanted to say there's a lot of contingencies right here, but these are levels to watch. And should the stock market go on to rally and let's say up to, and even especially if it took out the recent all-time highs, I would put a pretty high degree of confidence that we're going down, and these divergences would play out for at least that pullback there. Let me try to quantify it for you, what it would mean if we went to that 136.60s target. That's about a 3.6% drop, and down here would be about a 6.75. So maybe on line with this correction here, and of course it could play out for a while. And again, the miners would probably drop at least twice that much. That's usually the case there. Now the thing about divergences, as I say, being that they are not sell signals or buy signals. If it's bullish divergence, they're merely an indication that the trend may change soon because momentum has been waning. That's what momentum indicators are all about. What you need is a sell signal, and you can see we're sitting on a very nice support shelf. There's a big old gap. That's always significant, and really nothing much between. Even though you had a couple candles there, you had some pretty good reactions there. So that's why I figured if we break that level, from just looking at this chart, odds favor a move down if we make a solid and impulsive break. Remember, daily candlesticks are really what matters most on a daily chart, because there was an intraday break, but we snap back above there. So we want to look for an impulsive break. You get a jump start if you trade off the 60-minute chart. So sometimes if you wait for a daily close, the pitfalls can be that it could be a big move, and most of that move could already have completed by the time you get the daily candle finalized. I'm just drawing an example if we drop like that. So that's where you might get a jump start on the 60-minute charts. And again, keep an eye on the equity charts, the stock futures, or stock indexes, I should say, whether you're looking at QQQ or SPY, because that will most likely determine where gold is going, or at least have a big impact on it, since gold has had a very big flight to safety bid. Remember, once again, I've talked about it, and I'll get to it when I get to the US dollar, that all of this move right here, everything you're seeing since the lows back here in October, and that's a pretty big rally, and actually we're in August, that is almost exclusively a flight to safety bid. And again, I'll get to that when I look at the US dollar, because the US dollar has been strengthening, which is typically bearish for gold. That means gold goes down when the dollar strengthens instead of the other way around. So, you know, there's a lot of potential for gold if the US dollar finally reverses, and I'll get to that in a second. But I just wanted to make very clear that those are the two factors, the two primary factors that will drive gold, is a flight to safety bid, or, and you know, if that bid collapses, meaning the stock market's strong again, people are comfortable going back into stocks, then you get you know, that risk off trade reverses, and money comes out. And the other thing, of course, being you know, a rising or falling dollar. So I can say with you know, the highest degree of confidence, this has been a flight to safety. So therefore, if the stock market all of a sudden, economic outlook in the stock market, you know, participants believe that there's a lot more to go. Let's say the government throws everything they can. Trump is already trying to push through additional tax cuts, payroll taxes. I mean, he's trying to pull out all the stops to gun the market, yelling at Powell to cut rates. So let's just say a lot of that happens. You know, hypothetical, that could be a fundamental catalyst to give this old aging bull a little more life. So I'm just trying to tell you, there's, you know, charts are dynamic, so are the fundamentals, and those are things to look for. All right, let's move on to the weekly chart. GLD weekly, you know, this chart has played out very well. This is a great example of technical analysis. Here's a downtrend line. It's been in place for a long time. I was highlighting this downtrend line in this triangle when we were still in there. In fact, when we were back down to the bottom of it, and we went on, we broke out, back tested it. And again, on the weekly chart, these are weekly candles. So you want to see, you know, look at the weekly closes. Forget about these little skinny parts here. That's an intra-week break. That's called a candlestick shadow. It's the, you know, we want to look at where the bodies are. And so you had closes below. That was resistance. Finally took out the resistance. Resistance, once broken, becomes support. We back tested for a while there, a few months. Again, it's a weekly chart. Successful back test, and then boom, off to the races. And again, this was that big flight to safety bid that gold has had. Ran into this resistance level recently, 143.87. You can see these reactions right here. You have 1, 2, 3 candles right under that level, and a big red candle that stopped there. And you also have some reactions right here. This is my final near-term trend target. I've had this target since, I believe, back here when gold bottomed, you know, put in this big divergent low. That was the end of the bear market, the beginning of a new bull market in gold that we've been in since all the way back to December 2015. So in a nutshell, you're looking at, you know, a confirmed bullish trend, bull market in gold. You know, in fact, especially that we took out for a while there, it was in question whether it was a true bull market or just, you know, a consolidation period, because we had to take out these highs, which we did here, put them clearly in the rearview mirror. So, you know, if you're new to trading or technical analysis, an uptrend is simply defined as a security making a series of higher lows and higher highs, which we now have. So from that point there, and actually you can go back there, higher highs. So that's, you know, if you visualize it this way, here's your uptrend right here. This is the uptrend, this was a bear market, a downtrend, and this was a bull market. Primary trends, meaning cyclical bull market, cyclical bear market, cyclical bull market that we're in now. However, like everything, you know, you get overbought, you hit resistance, you could get a correction. Overbought, one of the, you know, best indicators for that is the RSI. I'll tell you right here. You can see we're at extreme levels last seen since the previous bull market. This is also indicative of a bull market. You don't typically become this overbought in a bear market. In bear markets, what you want to look for, usually, well, here's a bear market over here. When you're in a bear market, usually bounces to the 70 level on the RSI are very fleeting, and you don't get much more overbought. What happens in a bear market, oversold tends to become more oversold, meaning you go below that 30 level. 30 is the bottom considered on most charts, the oversold level. So you drop below 30 and you tend to stay oversold for a long time. Just like in bull markets, you tend to become more overbought and stay overbought for extended period of times and have these persistent overbought readings. Overbought, you hit it again, you hit it again. And in a bear market, you rarely become overbought, and if you do, that's usually your golden shorting op there. But you don't try to buy oversold in a bear market, because you tend to get burned, just like you don't short overbought in a bull market because it becomes much more overbought. And that brings me to this point here. So we're in a bull market, we're overbought, we've been overbought for a while. We were overbought right here, but you can see we hit it again. And just remember, like, divergences are not buy and sell signals. Overbought is not a reason to short, and it's not always a reason to get out of your long positions. If gold wants to rally, it'll rally and it'll continue to push up, and just usually the corrections are relatively minor. That was a very powerful, strong trend, but we could be looking at the same thing. In fact, if the US dollar, and I'm going to get to that in a second, starts to, the perfect storm for gold would be a falling US dollar and a very powerful bear market or correction, a falling stock market, and the more impulsive the better, because you're going to get that flight to safety bid and you're going to get the boost from the falling dollar as well. Alright, so there it is. Gold overbought at resistance, but again, I think there's more upside. To me, it's just a matter of, do we correct here? Do the divergences on the daily chart play out? Do these overbought readings play out for a little reset, like something like this right here before the next leg up? That's kind of where I'm at, guys. It's my view right here. I can say this: if you're not already long gold, it's not the most objective time to add. In a bull market, you get bailed out, you add, you get down, but again, I would prefer at this point to add to positions on a pullback here, and there may be even a shorting op for quick traders that are willing to short counter trend moves within a larger trend. Okay, so that's that. We can look at the 60-minute chart, might as well. I don't want to make this video too long, but here you go. You have divergence here. Here's a great example of a bullish trend burning through divergences. You can see a nice uptrend line right here. See that wedge in gold? 60-minute chart again. So you had clean negative divergence. Clean meaning, look at the separation in the MACD or the PPO there. Clean separation in the RSI. Making lower lows with prices making higher highs. You had a trend line as well, and you had a breakdown that didn't work, another breakdown, and you had a correction, but it was a correction mostly in time. There was a little bit of price correction, but mostly a correction in time. And so these divergences, let's say in a bear market, if you had a divergent high like this, you would expect the next leg down. Even in a normal, just kind of regular trending bull market, where, in other words, not a strong rally like we've had in gold that's been very impulsive, you would expect at least a decent correction. What I mean by that, one thing you look at Fibonacci retracements, go from that whole move up to the highs, you put up your fibs, and look how they line up with these targets that I had, or support levels. 130.20, 127.83 were the top and bottom of that gap, and you can see almost perfectly when I put the fibs up there. And there's 38 fib. Tried to circle 38 and the 50, and then the 61.8 here. That would be a typical correction. At minimum, usually you get about a 38% retracement, or maybe a 50% retracement. This tells me there is a voracious bid for gold. The sellers are nowhere to be found. Every little dip, or even a lack of a dip, just consolidation, new buyers kept stepping in. So like I said, tells me the impulsive nature of this rally. Then again, divergence here. Now, because it didn't play out then, it doesn't mean it's not going to play out this time. And again, if you want a level to watch, if you are long gold and you're wanting to maybe protect profits, or you want to try to get a short trade, that's the level right there. You can see as I zoom in, here's where we've been bouncing around 147.8 or so. It's about the same level I showed you on GLD a minute ago, or I'm sorry, on the daily chart. Let's look at, we'll get to silver in a second. Let's just keep on gold, stay on gold here, and let me look at gold futures. We'll just look at the 60-minute chart. So if you like to trade GC, the gold futures contract, there it is. There's your comparable level, about 1501. We'll call it 1500 to be safe. You're going to get little, intra-period spikes. Remember, trading a 60-minute chart, sometimes you get these little spikes and then you close back above it. But you can see that has just a very well-defined support level. And if that goes, then it could open the door for move down. You do have a reaction eye here that could come into play. And then you have these levels that I have marked here. So let's just say at this point in time, not even having a sell signal yet, which may or may not come, let's just say my max pullback target would be to about that 1445-ish level right there, and give or take. It's not super well defined, but it's the top of this trading zone, or roughly the top. When I say roughly, because we had, you know, a couple pops above it, a big pop here, but we came back down and we respected that level. So to me, that's it. If you're looking for just how far gold might drop if it triggers a sell signal there. All right, next up we'll do silver. Start out here with the daily chart. You also have, again, divergences. You can see here we had a divergent high back here in looks like late February or late January, early February. About double topped it there, and then boom, similar correction that we had in gold. This is what I call AD, or almost divergence. We made a slightly lower low, but almost made divergence. Either way, you had a falling wedge pattern and you broke out. So it's kind of wash, rinse, repeat stuff. You know, we had a divergent low right here. There's your bullish divergence. You look to get ready to position long, and what the trigger there on that pattern, you had a basing pattern, beautiful little basing pattern right here. That's the top of it. I tried to box it in for you, same thing. So boom, there was your breakout. We fell to this bullish falling wedge. There was your breakout, objective entry right there on the breakout, and we've come full circle now. We have negative divergence right up to this point here. I'm trying to trend line it here. There it is. There's your trend line. Here's your uptrend line, and again, we don't have a sell signal. If you look, you can see that there's some a similar support cluster right here. If I zoom in, see these candles similar to gold. So what you have here potentially as well is a big island cluster top. This is a cluster of candlesticks separated by a gap on this side. If you were to gap down, that would put in an island cluster top, and that's a pretty bearish pattern. And if that happens, I'll go over some ways how to trade that. But you pretty much, if you see the gap down, you can short silver, and then you want to put a stop somewhat above the bottom of the island in case it recovers that level there. So that's it. So divergences, overbought conditions, a potential buying climax. You know, volume on a rise is bullish, but sometimes when you have a very large surge after a strong run, that could be indicative of a buying climax, meaning it puts in a temporary or even a more lasting top. There's still a little more upside to a pretty significant level. This has been a long-term swing target or trend target I've had for a while, about 1637 on SLV, on the silver ETF. Let's look at the weekly chart. Here's your, you know, you go out to a 10-year weekly chart like this and it gives you the big picture. We had a bull market just like we did in gold. You know, gold and silver tend to run together. Look at that nice little flagging action. Look at this. See this impulsive move? And I talk about this quite often, that I find it kind of cool how the same technical patterns that you can identify and trade on something like a 1 or a 5 minute intraday chart work just as well on the weekly charts. This is an impulsive move up with a textbook looking bull flag pattern, and take a bull flag, you take the flagpole, the impulsive move leading up, add it to the bottom of the flag, and that gives you a measured target, and that looks almost perfect to me. And that marked the top of the bull. And then there was a big bear market defined by a very nice, well-defined, I should say, downtrend line, bullish divergence, everything you like to see. And so again, I could trade this pattern on a 1 minute chart, a 5 minute, 60 minute daily, but here on a weekly chart it indicates a much larger move. Now you had the breakout, you had an impulsive move, and you came back down. What silver did is it retested the lows. Gold had outperformed. Remember, we looked at the gold weekly, and gold's way up here, and that's why, you know, a couple of months back I became more bullish on silver. Said I thought it had more upside, and it did, because there's something called the gold to silver ratio, and what happens is when it gets out of whack, you get a mean reversion. You know, gold will always trade more per ounce than silver, but you know, they tend to move together. So if they get too far apart, in their percentage gains. You usually see a reversion to the mean. So there it is. You had this downtrend line. This is the last thing we was highlighted back here. You had a little divergent low at that point. You broke out. So silver appears to have much more to go in the long run, but you can see right here is 1634 is pretty decent resistance. You know, these, I don't know if you can make them out, but this is what my eye sees. Tons of reactions along that level from above and below. A lot of reactions going back there. So just like gold, you have silver coming up on a resistance level. I don't think it's the end of the bull run. It's a matter of, do we just power on through it and head on up to some of these other levels? You know, longer term, I could easily see us getting back up here. Got some work to be done, but that's where we're at. Just like gold, we're overbought. Even though we're in a bull market, you have to respect overbought. Last time we were overbought on the RSI was right here. Wasn't the best time for you to be buying silver. It was a much better time for you to be taking profits, or at least raising your stops to protect profits versus going long. So that's what I mean by not really an objective time to go long. Hey, silver can rally another 10-20% before a 5% pullback, and you might say, well, Randy, you told me not to buy silver. I don't tell anyone what to buy, not to buy. I just tell you when I think it's objective time to add, or maybe not an objective time to add to it. So that's where we're at right now. And again, I might be screaming buy next week or tomorrow, depending on what the stock market does. So right now, like I said, the kind of theme of the earlier video that I did today on treasury bonds, gold, and the stock market was we're at that inflection point where I still favor it. Even if we pop those, well, we have popped a lot of the stops today. I talked about in NQ. We had a pretty nice lift in QQQ and NQ, so there was a stop rate so far. But again, I see minimal upside, and I still favor more downside in the market. So I'm just giving you levels to watch here on silver. That was the daily chart. We already did that. 60-minute chart I haven't even had marked up yet, but you can see there, just like gold. You can see divergence. You can see a trend line. You can also see a gap. I haven't updated this chart in a while, but just like gold, you had one little whipsaw here. I don't know if that was a Fed day or what that was, but and actually almost backfilled the gap. But for the most part, the reactions there are about 1575 or so. So that's a level, and again, a potential trend line. Not a lot of reactions, but a potential trend line. So there was the last wedge that broke down. We didn't correct right away, but there was a little bit of correction in price and more so in time. And so again, that's what I'm seeing in the charts right now. This is silver futures on a daily chart. It stands out. You can see here at this point back here, negative divergence built to that point. There was a breakdown, a reversal, trend reversal. That downtrend ended with a divergent low right there. Rallied up here. We have this divergent high, and there's your trend line to watch on SI, silver futures, with the negative divergence right there. Let's look at it on a 60-minute chart. I should have for you right here, and there it is right there. You have this downtrend line, big symmetrical triangle pattern here on a 60-minute chart, which could go either way as well. So those are your levels to watch. We had a little brief pop there, but there's a good example of a breakout that was not impulsive. So it was a whipsaw signal, wasn't an impulsive break. If you get an impulsive break to the upside and everything else confirms, the stock market, the US dollar, gold, then that would be bullish, and you could actually get another leg up in silver. Or of course a break to the downside. You can see this is my first support, and it's a pretty good support. So if you're looking to maybe, if you get that sell signal on a downside break and you're looking for a swing target, look, you could even or you could even short silver here, because we're at resistance. Like I always say, resistance is resistance until unless taken out. So it's subjective. Maybe not the highest probability trade, but you can, I like to sometimes weigh out the probability or the chance of a trade playing out. In other words, how strong is my conviction versus the risk reward. But if the risk reward is very favorable, better than average, I might do that. Take a short position with a very tight stop, relative to my price target. So that would be again a nice pullback target. We've hit that level several times. Now, if we get down there and we break it, that's a pretty important support level. You can see how many times it's been successfully tested. So you have to, of course, if we even start to head there, we just take a look and see how everything looks at the time, such as gold, the dollar, the stock market, to try to determine, let's say you were short, then maybe you want to hold on lower stops to protect profits and hold out for a much bigger drop if that were to play out. Likewise, if you break out, same story. You break out, set a stop below, somewhat below your entry, and if its trade starts to pan out, you can trail your stops up. Palladium, we'll just look at the daily chart. This is my preferred ETF if I'm going to trade it, PALL. You have this symmetrical triangle pattern right here on the daily chart. We're smack in the middle of it, and there's a gap overhead too, which could come into play as resistance. So this is in what I call technical no man's land, smack between support and resistance. Let's see if I have anything on the 60-minute chart of the future. Nope, not. I mean, well, yes, but no. Well, there is a trade there. Yeah, there was a trade to be made today, actually. I had it right at resistance, 1492. It's been a busy day, or I might have taken a shot at that. Yeah, that's a nice level. See that you had that support shelf right here. It was broken, and it wasn't just broken and traded through. When it broke, Palladium fell very impulsively. So that confirms that is a very technically significant and important level. So when you rally back to it, that was a no-brainer short. Hindsight, wish I would have looked at it earlier. I told you this morning I was planning to get to this video and look at these. There, you can see that level again. Look at this. Perfect, support, 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 a lot of tests, and then when it broke, boom, the bottom fell out. So yeah, that was a very, very high probability, even for a quick pullback trade, or you just short it, you swing it down to, that would be my target right there, 1450 or so, just above that, and or this uptrend line right here, which is the bottom of that that triangle pattern there. So that's PA, the Palladium futures. PPLT is platinum, and you can see just a big old symmetrical triangle pattern, which we're smack in the middle of. So now let's look at the futures chart and see if there's any trades there to be made. Well, you can replicate these charts. When I'm doing the videos, just pause the video, take a screenshot, and replicate these. But that looks like the pattern to me. Nice symmetrical triangle pattern. So it's a common theme here as I'm doing this video. A lot of the metals here are in these triangle patterns, and they can break either way. And so we're probably looking at the next big trend in the metals, depending on which way these guys break. Okay, now on to the dollar, and then we'll get to the ETFs on the miners, and we'll wrap it up. All right, so as I said before, the dollar has a very big impact on where gold goes. And if you're new to my analysis, the reason it's very simple. Gold, at least the gold we're trading here in the U.S. and mostly around the world, but not everywhere. It can be traded in different currencies, but it's usually just like crude oil, but based in US dollars. So GLD, the ETF, that is certainly, and gold futures that I showed you, GC. And so it works this way. If the dollar goes down, let's say drops 10% in value, it takes more dollars to buy an ounce of gold, all other things being equal. In other words, holds supply demand equal as a constant. Dollar depreciates, it's going to take you more dollars to buy an ounce. Likewise, if the dollar appreciates, goes up in value, it takes fewer dollars to buy an ounce of gold. So there's the relationship. So they're inverse. Dollar goes up, gold goes down in price. Now, as I told you in the beginning of the video, the dollar has been on one of the strongest trends in years, other than this rip right here. This has been a relentless and strong bull. And all that while, as I showed you, since late 2018, gold has been rallying. Had the dollar fallen by this much, gold would have exploded. It would have been up 2-3 times what it has been right now. So it tells me, again, as I said earlier, that's my evidence that what you saw was virtually 100% flight to safety bid, concerns about where we are in the economy, where the stock market's headed. There's no doubt in my mind that that's the flight to safety bid. So now if you can kick it in with a falling dollar, that could give gold the next leg up, from in the bull market. And so looking at this weekly chart of UUP, the dollar ETF, or ETN I should say, You can see it's at a major top right here, that previous reaction high from late 2016, early 2017. We had a major reaction high here, so this is really a resistance zone here, and you're in the upper end of that resistance zone. You also have this uptrend line right here off the lows. In fact, that makes this bearish rising wedge pattern complete with negative divergence. To me, it's a simple wash, rinse, repeat thing. The dollar has been resilient. I've been looking for that reversal for some time, and I still think it's coming. We had a divergent high there. There was a big drop after that. We had a divergent low afterwards. That preceded the big rally. Now we have a divergent high. So this chart tells me it's just a matter of time before these divergences played out. In fact, we already had the sell signal. Dollar broke down, and it's been back testing the trend line from below. We just need to now see, what we need to really see is this minor uptrend line as it's been back testing. We need to see that go, and really that 26.46 level on this weekly chart. So I think if and when the dollar does this soon, puts a big candlestick down here, you see a red candle weekly close down below that level, and that trend line in this 26.46 level. This is what topping action looks like. Look for a lot of big red candles on the weekly chart. Looked like we might have had one there. We had a sell signal. I thought that was it at the time, but nope, the dollar had an extra, leg up, and sometimes breakdowns like that happen. The breakdown was legit, but it's been back testing since. So that's what it looks like on the weekly chart. Daily chart you can see here, and of course this is just the ETN. I like to use one of my proxies for the dollar. It's a Euro US dollar Forex pair, because the euro is by far the largest component of the US dollar index. Makes up almost 2/3 of the US dollar index. So if you watch this, and the bigger picture on it, and go to the weekly chart, is the same thing in reverse. So you're basically looking at the US dollar flipped upside down. So when this rallies, when this chart goes, prices go up, it's the euro going up, means the dollar falling. So the bullish scenario for gold, if you replicate this chart, would be a reversal here. And what I see is a clean. We've been monitoring this wedge for well over a year now. We broke out, but we had resistance levels that we hit each time, and we've come in and back test, and we're still back testing, and there's also some support right there as well. So you have the dollar, our euro US dollar, breaking out and currently back testing. So it's still in a bullish technical posture with buy signals, but we need to get away. You can back test for a while, keep moving lower, or maybe the breakout fails. It hasn't yet failed, so I haven't given up on that. My view is that we're going to see a major trend reversal in the dollar as of now, because the charts are telling me. And don't even start the conversation of fundamentals. Well, we're the best, strongest country out there. You can sit there and debate all day long fundamentally why the dollar may continue to strengthen, and maybe your arguments are right. I'm just telling you from a pure technical perspective, and given the two all day long, I would put much more stock into the technicals than I would fundamentals, because they usually price the fundamentals in advance. So there it is, bullish falling wedge, breakout, back test, just like you had a bearish rising wedge breakdown that triggered that trend. You had a big giant a falling wedge there, bullish falling wedge, and so all these trends, again, they're clearly identified by these breakdowns, divergences. It's not marked here. There was a rising wedge there as well. Simple wash, rinse, repeat kind of stuff. So this is what we're looking at. And again, if it starts to materialize, and when will we know that? Well, it looked like we had a couple false starts here on the breakout back test before. Like I said, so where I expected us to go up, continue to go up and take out, we did fail at this downtrend line, which was resistance, and we still need to take it out. But here's a beautiful part of this, is that I had expected a bigger rally in the euro, bigger drop in the dollar so far, but I still made money because I don't trade Forex. I'm not a Forex trader. I only use this to trade gold, and I've been bullish and long gold and silver and the mining stocks, several miners, for better part of this year. So that's one case where so far I haven't got the call right on the euro US dollar. It hasn't panned out, but yet the thing I was tracking it for has. So like I said, the flight to safety bid has made gold and silver and the miners go up. So that's a good thing, and if we could just kick this one into gear too, all the better. And of course, everybody loves the miners, myself included. I always say the miners are simply a leveraged play on gold. If gold goes up X, the miners will go up 2 or even 3 times X. And it cuts both ways too. So if you're on the wrong side of that trade, or if you're shorting, you can, you get more bang for your buck trading the miners. There are some disconnects, really depending on what's going on in the stock market. For the most part, that holds true. And if you don't want to take it on faith, just pull a 10+ year chart of gold, overlaid GLD and GDX on the same chart, and you'll see the trend. They move in the same direction. This is the daily chart, negative divergence, just like the metals themselves. Clear negative divergence. They've been building. We had a trend line here. You can look at it this way. This was a steep wedge with a breakdown and a back test, and I have a secondary uptrend line here that could trigger a sell signal. But again, you want to, if you're in trading only the miners, just watch those charts on gold and silver. If they break down, it's only a matter of time before the miners follow. So that's one way to trade those. Let's see. Let's look at the weekly chart for GDX. Beautiful long-term chart. You had the downtrend line here. You had also nice, like gold, you had a symmetrical triangle pattern, which just like gold, silver was broken out, back tested, and a nice leg up. This is my initial trend target for GDX. In other words, when we get here, if gold is at resistance and silver and some of those levels that I've talked about, that's where I would be looking for a considerable reaction, either a consolidation and or pullback. Maybe even look for a counter trend short trade on the miners, and that'll certainly book some profits, or maybe, depending on what's going on in the stock market, at the very least tighten stops up, because ultimately I think GDX at some point, maybe this year, possibly, but almost certainly by next year will come all the way up here to about 40.29. From where we're at now, you're talking about another 44% upside, and if you're picking individual miners, a lot more than that. A lot of those will be up triple digits by then. I like to supplement a core holding of like GDX or the silver miner ETFs with my favorite picks in the sector, like I highlighted a couple months back on a handful of silver mining stocks, which have all vastly outperformed GDX and SIL. And SIL, remember, you're going to have a lot of overlap, or a good deal of overlap. GDX, it's called the Gold Miners ETF, but a lot of those companies are also, they mine silver as well. So there are some overlap between the two. I just wanted to point that out. But for the most part, they're going to move with the metals. And you had a downtrend line right there, nice bullish falling wedge, positive divergence, everything I like to see. Breakout, back test. So this is like that US dollar. We broke out. Sometimes you break out and run. Sometimes you break out, back test, and then run. The US dollar, in other words, is right here when I showed you. We broke out and we're back testing. So if we get this thrust up in the dollar that I just showed you, or the euro US dollar pair, I should say, because that's the one I was looking at, then that would be the catalyst for the next leg up. And silver, you can see my next target here, about 34. We've already hit my first target zone right here, 29.70ish to 30.50ish right there. Pretty decent resistance. So again, the story, same story. The miners in the metals were overbought at resistance with divergences. So if the stock market can hold up, then they will probably correct. If the stock market continues to rally from here, they will almost certainly correct, in my opinion. However, if the stock market turns around and takes another sharp leg down, they may just power. That might have been it. We already had a reaction at resistance, and maybe that's the all the reaction that we need, a little bit of consolidation. So you look at it this way, move up, we've consolidated here under that resistance target zone, and so we could pop up. That was the day or the weekly chart. There's the daily chart. If I didn't cover it on, you can see nice resistance. So here it is, silver SIL. Again, this is the silver miners ETF. Hit that 3013 targets resistance area. You can see it right there, and with a divergent high. So far, it's pulled back, and again, it's correcting lately, more so in time than in price, although it was a decent pullback. Remember, these guys are volatile, so you got to expect these miners can easily move 5, and sometimes I've seen even the ETFs move over 10% in a day. And of course, the individual mining stocks can do a lot more than that. Alright, last one, because the video is getting about as long as I ever like them to go, is SILJ. We have an official trade on that. Good time to tighten up stops. We hit our first target here, that 969 level. We hit it a while ago, and again, you know, this is gonna what happens here will depend on what happens with the metals. So there's your uptrend line. We broke it and we're back testing. I had a resistance level just above that, about 1018, and we're back testing that. So right now we broke support, and so we're back testing resistance, negative divergence as well. And you know, how you want to trade it, I put it on as a long-term trade. So I'm going to leave this stop in place now, willing to ride out, you know, on the official trade, any pullbacks, you know, should these divergences play out for a deeper correction than they already have. And you know, ultimately I still have confidence these targets will be hit in the coming months. So it's a matter of, again, you define your trading style. If you're an active trader, you want a game, that's the reason I list multiple targets. That's on the FAQ page on the right side of the chart. Why, the reason why I don't just list one price target, I list multiple targets. Some traders want to hold on, ride out the zigs and zags, hold out for the prize. Others might, you know, only want to target the first target. It has a higher probability of success, obviously, than the final target. And others will be active traders. And you can see here, and this is most often, not always, most often the case. When I have these price targets, we hit them and we have a reaction. You could have covered, you know, sold your long, reversed to a short, and then swung it up to that next. We fell so far a little shy. How shy did we fall? Remember, I set my price targets a little below the actual resistance level. 1084 is T2, but the line's at 1096. And so far we had a high of, what, 1082. I think is that it? We came within 2 pennies of my price target. And what that tells me, guys, too, is that if I had a price target of 1084, because I already adjusted it down, we hit a high of one of these candles, I think was 1082. Well, either way, we'll call it within a couple pennies, and then had a reaction. Effectively, that level was hit. It means I was just a couple pennies too high on my adjustment, setting it below the actual resistance level, and so we already had that reaction. Now, don't count that. I'm not going to, you know, post it as that target was hit, but I want to say, you know, for all intents and purposes, that because we came close enough to that resistance level. But again, I'm leaving all these targets in place for now, and you guys decide how to trade it. All right, long video, but again, I wanted to cover a lot. They're all interrelated, is why I wrapped them all together. And you know, hope you guys find this stuff useful. If I see anything significant, such as breakdowns but below those levels, or you know, the bearish divergences start to dissipate and it looks like we're going to get another leg up, I'll do my best to communicate my thoughts as soon as possible. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.